I'd be more concerned about the yield curve inversion if it was a case where the two-year Treasury yield was ahead of the 10-year Treasury yield. That isn't happening, not quite yet. So I would not look at this inversion between what is a 3- and 5-year Treasury yield as signaling an imminent economic downturn. Nevertheless, the equity market appears to be worried about the health of the economy going forward. We see that in today's price performance, as you mentioned earlier. Transportation stocks are way down. Interest-sensitive housing sector stock prices are down 3.8%. That's deeper than the market's overall slide of just about 3%. So there is some worry about the sustainability of the economic recovery. However, at this point, I believe those worries are overblown.
What do you think happens the rest of this week? Tomorrow we're closed. We're closed for business.
Tomorrow. We'll be waiting for the employment report on Friday. I believe that the employment report will be healthy enough to alleviate fears of an impending recession. That being said, I would tell the listeners that what happens on the employment front provides us with a very good indication of what near-term economic performance might be like. We're not there yet, but suppose we have a situation where the now 3.7% unemployment rate over the next 3 months goes, let's say, above 4%. That would offer a pretty strong hint of danger on the business cycle front. That would indicate the danger of a possible recession. Keep an eye on that. Also, the monthly increase by payrolls. If that averages something in excess of 150,000 jobs per month, the economy is in pretty good shape, and an economic downturn should be avoided.
So, John, Miles Ludden here. I can kind of hear you saying that you think the economy is going to be fine, and a lot of people are saying that. A lot of the data that I look at would also confirm that. So what do you think the yield curve is trying to say here? Is it really just about the Fed? Is it about the demand for longer-dated treasuries? Is there something that people should be worried about other than just, well, throughout history, the yield curve has inverted at some vague point before a recession hit?
The credit market is telling the Federal Reserve to take it easy on the interest rate front. Yes, we could probably handle a rate hike at the December 19th meeting of the FOMC. That brings Fed funds midpoint up to 2.375%. The market believes, however, that there is room for only one rate hike. In 2019, the Fed funds futures currently assign only a 30% probability to a Fed funds midpoint finishing 2019 at something above 2.625%. That implies only one rate hike next year. So I think that the credit market, the Treasury bond market, and the equity market wants the Fed to admit to the reality of the ongoing slump by home sales. It's a pretty severe slump. You're down by roughly 7%, 7.5% from your peak of the fourth quarter of 2017. And the Treasury bond market also wants the Fed to recognize the containment of price inflation. One of the reasons why Apple got into trouble is because Apple overestimated their power to set prices. One of the reasons why earlier in the year motor vehicle sales were slumping was because Detroit overestimated its power to set prices. The reality is that we have a very competitive marketplace out there. Consumer incomes are rising, but they're not rising rapidly enough to support a situation of recurring price inflation, recurring price hikes.